I've got a review already in the playlist. Okay, so you've got a chapter 7 review, and you got chapter 8 review. I think actually in week 13, I may have done a full review. Let's just look at that real quick. And then you also have a chapter 7 quiz problem 5 in there, which might be helpful. Let's see. I should probably move that at some point. I will, but let's see your videos. Let's go see what's in week 13. Week 13, what do we got here? And yeah, because week 13 might also have a review. Let's just double check what we got here. Week 13, chapter 9. I did not do a full review of chapter 8. So let me do that now. Okay, McGraw-Hill. Let's go to chapter 8. Well, you do have a preview. I don't think chapter 8 is going to be, oh yeah, long-term assets. That's the wrong one. Okay, chapter 8. Chapter 3 is on assets, right? So you're going to be talking about basically 3 types of long-term assets. One is plant assets, natural resources, think of gold, silver, natural gas. What else might be in there? Coal, diamonds, anything that is a natural resource, how they determine the value of those assets, and then the intangibles such as patents or what it would be goodwill, things of those of that nature. How do you evaluate it, and how do you then effectively depreciate it over time if you can? Okay, now let's go to the next page. So on plant assets, it's going to go over, okay, what type of equipment or things of that nature are considered a plant asset, right? So you can include it's used in the operations, right? A computer, piece of equipment, a car, lots of different equipments, right? So you have an acquisition cost, you use it over a period of time and then dispose of it. So it's going to walk you through how do you figure out what's the acquisition cost, how do you allocate that cost over time, and then how do you then dispose of it when you record it. All right, so depending on the type of equipment, you're going to have different types of costs that are includable. Now, this is really important to work through. All right, because you have machinery and equipment, pretty straightforward. What's included in that, right? The purchase price, taxes, charges, any insurance in transit, and the cost of assembly and whatnot. Buildings are a little bit different. Okay, because you have different scenarios about a building. So make sure you walk through this and understand what's included in the building. Land improvements, pretty straightforward, right? Parking lots, driveways, walk fences, anything that's an asset, a long-term asset that can be used over and over and over is going to be land improvements. Land, basic cost of purchase, right? But it could also include all sorts of other stuff. What you paid for the land, the commissions, the fees, the legal fees, property taxes, right? The payments for surveying, clearing, grading. There's a lot of stuff in here for land that you'll need to make sure you understand, okay? And then, let's see. I'm not sure why they go over lump sum purchase, but usually if they're built as a grouping, then how do you allocate the cost between everything, right? So make sure you go through this video. It'll walk you through the cost determination component. And then you have to depreciate these costs over time. Now we got a flavor for that in the repair costs that we went over already, right? For your ethics exam, ethics number 2 assignment. But you have a cost, you have a salvage value, which we didn't include last time, and you have a useful life, okay? There's lots of different depreciation methods, but the most straightforward way is a straight line method, which is just going to allocate over time. Okay, so you take your cost minus your salvage value and divide it over your useful life. That gives you a depreciation that you do per year, which usually then translates into the depreciation value for a particular month, right? So 1,800 divided by 12 would be what your monthly depreciation is. Okay, so they walk you through what that journal entry looks like, a depreciation expense and accumulated depreciation. Okay, and then this is what it looks like on an annual basis. And then you have a book value, a net book value for the piece of machinery that decreases over time. Okay, this is the original cost minus depreciation each year until you get to a particular book balance. Okay, and I call it the net book balance. I call it net asset value, net balance sheet amount. Right, so this is an amortization schedule. You'll need to learn how to create these, all right, which is pretty easy to do, actually. I think I might be able to do this here real quickly for you. So if I pull up an Excel file, and let's make this bigger and smaller at the same time, let's look at what they have here, right? So you usually have a year. Okay, you have a depreciable cost. I don't like to do it this way. Let's do it a little. So you have your cost, you have your salvage value, you have your useful life, right? So let's say I bought a car. Okay, I'll make it simple, and that car is $30,000. Okay, it's going to have a salvage value, let's say, of $5,000 when I get at the end of its useful life, and the useful life is, let's say, 5 years. Okay, so my depreciation, annual depreciation, make this annual, okay, is going to be the cost of the item minus its salvage value divided by the useful life. Okay, let me change this formula just a little bit. There we go. That's the formula, right? So cost minus salvage value divided by useful life. That's a pretty basic calculation. Okay, so $5,000 per year is what we're going to depreciate. So what you would do is you have your period. Okay, you might have your you're going to have let's call it the net. This is going to be easier than the way they did it a little bit. The net beginning balance. Okay, you have your depreciation, and then you're going to have your net asset value. So let's just call this beginning balance. Okay, and then you have an ending. This is effectively an ending balance. Let's call it that for a second. Okay, so now the way this is created, let's see if I can make this look a little bit better. We'll just make these 15, and then we can have period 1, 2, 3, 4, 3, 4, 5. Okay, my beginning balance is going to be on this one what I started out with, which is the $30,000. The depreciation is going to be this value right here, and my ending balance for the year is going to be the beginning. And this assumes I purchased it. Let's say it purchased on 1/1/2023. Okay, at the end of year 2023, 2024, 2025. This is what 26. This is how it's going to look. All right. Now, once I have this set up, then I can just do a couple of things. I can do this equals that. The ending balance, beginning balance equals the last prior year's beginning balance, ending balance, sorry. And I can just copy that down. I know this formula already takes the beginning and subtracts the depreciation. So voila, I got that. So now I just have to put in this depreciation amount. It's the same for each year. So we'll just make it the same all the way down. And so now what you'll see is by the time we get to the end of year 5, we'll have a $5,000 ending balance, which is called the quote net asset value on the book value. Okay, there's a couple of different ways of saying that. That's the ending balance. It's $5,000 salvage value. Theoretically, then you can sell it at the end of the 10 years. If you sell it for $5,000, you have no gain or loss. All is good. If you sell it for, let's say, $6,000, then you have a gain or loss. If you sell it for $4,000, you have a loss. And so that's what it's trying to help you work through, right? What's your book value at the end? Okay, and this just walks you through a scenario of how to do this. I did a little bit more simpler, I guess. I figured out the calculation here and then I worked through it. Probably the reason why they have you work through this a little bit more detailed like is here, because if you do a double declining balance or you do something else, this depreciation value is going to change over time, but you can create the logic in here instead of having it spelled out like it was over here. In any case, that's the basic depreciation. On your unit production, it's going to be very similar, but you're going to have let's say in this case, what are they looking at? They're looking at plant assets, unit of production for what type of, I'm not sure. Anyway, your cost versus your salvage value, same thing, divided by units of production. So in this case, they said we can do 36,000 shoes with this whatever plant. So it's 25 cents per shoe. So every time you sell a shoe, you're going to depreciate the plant asset by 25 cents. So 7,000 shoes over a period of time times 0.25 gives you 1750 in your depreciation, right? It's going to work through the same way. You can create the depreciation schedule just like this if you'd like. And this is a double declining balance. So every year it doubles up. You won't have to worry too much about this, but definitely make sure you understand the concept. Okay, because there might be something on the test about it. And you can see the comparison here and then depreciation for tax reporting. Okay. Partial year depreciation, you definitely want to understand. So like in the prior example, I started out with it being depreciated in full for the whole year, right? So let's say I bought it if I bought it on 6/1/2023, well, for the year, first year months, let's call it, okay? So I'm going to have equals 12/31 to, let's see. There's an easy way of calculating this, but I'm not going to go through that. Let's just go, okay, by hand, 6, 7, 8, 9, 10, 11, 12. So there's 7 months. First year months. Oops. Months is going to be 7, right? So what we'd want to do is we want to, so this is a monthly depreciation. Let me insert here. Monthly depreciation. Take that number divided by 12 gives you $416. So in this first year, it's not going to be the 5,000. It's going to be the 416, which is my monthly depreciation by the number of months. Okay, and let's make this a little bit easier to read. Okay, so that's going to be my depreciation per month, my ending net book balance. Now you notice that in this month, we want to change this to the 5,000 because that's what it's going to be annual. And then there's going to be a little extra. So effectively in 2028, there's going to be a beginning balance of 7,052. And we're going to depreciate it for what, 5 months in this one, right? So we're going to take 5 months worth of depreciation times this to get us to the full year. Let's do that. And so now when we do this, we'll get to the $5,000, right? The salvage value. So you got to remember, when you purchase it during a year, if it's not a full year, you have to effectively only record the number of months in that year with the depreciation. Okay, so that's a partial year depreciation. And then you have changes in estimates. Anytime you change an estimate in terms of, let's say, useful life, or let's say you did, like on the ethics assignment, you did a repair, so it's going to extend the life, it's going to add to its overall value. You have to modify that as well. Okay. All right. That's a quick review of that. This kind of walks you through this whole process, both in a straight line. Is this double declining? This looks like double. No, this is units of production. Okay, this is a double declining approach. Okay. Do they have straight line in here? No, it's just, oh, they do. They have straight line, units of production, and double declining, different approaches to doing depreciation for the specific scenario. So this is a good exercise to walk through and make sure you understand. It's also going to go through any type of capital expenditures, ordinary repairs, extraordinary repairs. Is all part of 8. In fact, now that I'm looking at this, you're probably wondering, if I go back on the modules, let's just double check this. Chapter 8, 11. Oh yeah, you already started working through 8. Okay, so you got most of this. You're just doing that's right, you're doing the quiz. Okay, so this will walk through any betterments, extraordinary repairs. This is what you've done on the ethics assignment. Any discarding of plants, selling of plants. Let's see, sell at book value. This is a plus or minus depending on what the book value is. This is the gain or loss on the sale. Natural resources. Okay, not too bad. And then intangibles. Now this intangibles is, something that's not a physical asset. It'll be a patent, a copyright license. These usually are, in paper form. They're not necessarily in a physical asset that you can sometimes touch and feel. And so this is going to walk you through what that does, how you amortize the cost over time, or if you amortize the cost over time. Some assets you don't, you just leave them the way they are at their original cost you purchased them by at. So it could be like goodwill, for example, doesn't get amortized over time or depreciated over time. It just it's left as it is when you bought it, unless it's impaired, and then you'll do something on that. Okay, so walking through this and understanding the different types of intangible assets is important. Then you have your asset turnover ratios, and that's about it. Okay, so the rest of this week then is just, okay, your quiz access and your exam. So that's pretty much it. Let me know if you have any questions. I'm happy to do, I'll have office hours on Tuesdays, Thursday, and Saturday next week. If you have any questions, give me a holler. Take care.